I also saw a tweet from, I guess, a couple news outlets covering Charles Hoskinson's predictions on ETH 2.0, saying it wouldn't be ready till 2024 and not before 2023. I actually tweeted at him because it wasn't very clear if he was referring to the merge or specifically to ETH 2.0. As we've seen, the rebrand of ETH 2.0 makes this extremely difficult to understand what's exactly happening. What are the components of ETH 2.0? A lot of people would say like the beacon chain is ETH 2.0, and that basically the execution layer is ETH 1.0. And the merge puts those two together, basically putting the execution layer and the consensus layer together and converting one into proof of stake. And then that's when you get basically the new Ethereum, is when you combine ETH and ETH 2.0. Whereas previously ETH 2.0 was this idea of fixing scalability, adding sharding, adding multiple shards, and also adding in proof of stake. So was Charles talking about specifically just the merge, or was he specifically talking about the dank sharding or adding in these other features that were supposed to be coming along? It's really hard for me to tell, but either way, we are getting closer to what I would consider the merge. We have a successful testnet merge. It's complete. Coming from CoinDesk for the wrap-up, they say the first testnet dress rehearsal sets the stage for Ethereum's pending transition to proof of stake. The Ethereum blockchain's first dress rehearsal for its upcoming merge was successfully completed Wednesday. The Ropsten test network successfully merged its proof-of-work execution layer with the beacon chain proof-of-stake consensus chain, a process identical to the one that the main Ethereum network will undergo in just a few months, if all goes well, of course, they say. Now, I already have this tweet pulled up here. Ropsten network just merged. You got the proof, all that fun stuff. Proof of stake activated. The merge is a long-awaited milestone in Ethereum's journey towards a new proof-of-stake consensus mechanism. Currently, Ethereum depends on proof-of-work, whereby miners expend energy to discover new blocks and add them to the blockchain, earning newly issued Ether and a portion of the transaction fees and tips. Once Ethereum shifts from proof-of-work to proof-of-stake, validators who have staked the required 32 ETH will take over the role of adding new blocks to the blockchain. Currently, the beacon chain runs in parallel with the current proof-of-work chain. The beacon chain is the proof-of-stake coordination chain that already has validators creating and validating new blocks in tandem with the proof-of-work execution chain. Once the proof-of-stake chain has been adequately tested and secured, the two chains will merge and Ethereum will continue as a proof-of-stake blockchain. The complexity of such a change to Ethereum's code requires multiple tests on various testnets. Ropsten's merge is the first test of its kind, and its outcome will help inform developers' future steps as they proceed towards the real merge on mainnet. Other testnet merges on Goerli and Sepolia are expected to happen in the coming months. Now, I think the timeline was moved now to a testnet every 3 weeks, so we would expect them to announce a testnet merge of Goerli in 3 weeks from now. So that would put us in the first week of July, something like that, last week of June. And then from there, closer to August for the last one. And then from there, they said 2 months from August would be mainnet at best case. That puts us outside of kind of the network problems of basically block times. So from the miner's perspective, there are a couple things that could happen, right? One is it gets accelerated back to the 2 week timeline, I guess, potentially, so that they can reduce block times. And in which case, I guess it would have to happen earlier, first week, or probably like, I think by July 15th or something like that, they would need to merge. I'm not really seeing that as a possibility. I think they have to delay the difficulty bomb so that the block times don't get too high. They have said they're accepting of 25 to 30 second block times. Once we start creeping into August, I think the exponential difficulty growth on the network is going to push that block time beyond where they want to be and cause a lot of network problems. they're also just, with the optimism issues that are going on right now and the potential for that to basically be hard forked and completely crash one of the roll-up solutions for layer 2 that they have going on. There's a lot going on here that I think could end up requiring them to push this out further. Was Charles Hoskinson referring to proof of stake move when he said ETH 2.0? I don't know, but I'm leaning towards at least some sort of difficulty bomb delay. What does that mean for the miners? It doesn't mean necessarily that proof of stake gets delayed. What it would mean is that you would have higher profits for a short amount of time running up to the merge for proof of stake, because the difficulty would be reset. Because right now what's happening is the difficulty is artificially increasing, hence why profitability in the amount of ETH that you're mining for the amount of hash rate you have is going down. And they obviously don't want that to happen too much because they don't want too many people to start moving off of it. We talked yesterday, a little bit about Hut 8. I highly recommend checking out that video with Hut 8 and NVIDIA. One of the things that we really gathered from that in particular was that they're prepared to move to other networks. The question is if there's really any other network that can support the amount of revenue they need and the easy liquidity in a bear market to be able to survive it, really. And I'm not sure that that's necessarily the case either. What we'll have to see is the difficulty getting high enough on Ethereum to where any other network is more profitable, and putting pressure on large GPU mining firms like Hut 8 and whoever the other two that have been getting these special NVIDIA GPUs outside of the main market, and see where those guys are going to go. And then until then, I feel like it's hard to determine essentially any sort of profitability. I know that Red Panda Mining apparently came out with a video talking about profitability today. There's also been rumors of profitability dropping 90% from other sources. I'm aware of all this. I can tell you it's going to get bad. I can't tell you how bad. 90% maybe. I don't know. But I can just tell you it's going to get bad. And I think the problem is here too, is I think ETH gets bad, right? So let's get into this one brought up by Nathaniel in chat just at the beginning, because this really this opens up some talking points surrounding the move to proof of stake and some of the issues they're going to have. One of the things that I've brought up a couple times is that the problem with proof of stake, especially as it pertains to Ethereum, and I think the reason why they have withdrawals blocked post-merge is not because it's difficult to add the withdrawal factor right into the code. I don't think it's that. I think that essentially what ends up happening is that your revenue on proof of stake, especially right now as it pertains to Ethereum, is extremely low. We're talking 5 to 8% APY. That's significantly lower than, of course, mining cryptocurrency. So your incentive for Ethereum is not necessarily to generate the revenue off of the staking, but to generate essentially the increase of price of Ethereum. And when this happens, essentially what you have is the inverse effect of proof of work. What you end up having is, as the price goes up for proof of stake coins, the security goes down because the people that are staking are more inclined to sell as the price goes up than they are to buy and validate the network. It's the exact opposite of what happens with proof of work. When the price goes up with proof of work, more security goes on in the network. With proof of stake, especially as it sits with Ethereum or pertains to Ethereum, as the price of Ethereum goes up, the security on the network goes down because the stakers are incentivized to sell. But we have more issues too. DeFi contagion. Analysts warn of staked Ether depegging from Ethereum by 50%. Liquid staking firms could default on their Ether obligations if the merge does not happen. And this is I'm going to disagree with this article probably a little bit, because the way they're setting this up is they're saying if the merge doesn't happen, the stakers won't be able to unstake, and then we will have basically a depegging of Ethereum from basically staked Ether, Ether, which also is a little confusing because we have to basically define what those things are. Your staked ether, or S-ether, right, is technically just a wrapped token of Ethereum that represents a staked portion of Ethereum that presumably whatever provider you're working with, even if it is a DeFi model, has staked in Ethereum. This presents a couple problems because, as we know, the actual stakers, so the person that is setting this up and allowing you to stake with them, they have to have that Ethereum locked up and they aren't going to be able to withdraw it. The idea is that if the merge doesn't happen, everybody will be pulling out their staked Ethereum, and of course the supplier, or whoever actually has the Ethereum staked that is representing your staked Ethereum that's getting pulled out, will now no longer have tokens backing whatever is staked. So then you end up having a decrease in the price of the staked Ethereum because it's not actually backed by anything because it's locked up and they can't get rid of it. The problem here, like I said, is even post-merge, this problem still persists because you can't withdraw post-merge yet. So post-merge, if like the price of Ethereum skyrockets and everybody that has staked Ethereum or wrapped staked Ethereum, I understand this is confusing, so hopefully I'm articulating it good enough. If the price goes up and they decide they want to pull that staked Ethereum out, you still have the same problem post-merge as you did if the merge didn't happen, because you still can't withdraw it, okay? So their argument here is that because you can't withdraw it when the merge, because the merge didn't happen, right? That people will pull their staked Ethereum out and therefore decouple the wrapped staked Ethereum from the actual staked Ethereum, and then you have a decoupling. This problem persists post-merge regardless, because we know that you can't post-merge actually withdraw the truly staked Ethereum. Hopefully that makes sense, but let's get into the article. The next big crypto crash could be around the corner due to Lido staked Ethereum, ETH. A liquid token from Lido protocol that is supposed to be 100% pegged by Ethereum's native token. Notably, the staked ETH peg could drop against ETH by 50% in the coming weeks, raising the risk of DeFi contagion as Ethereum moves towards proof of stake, argues popular Bitcoin investor and independent analyst Brad Mills. In detail, investors deposit ETH into Lido smart contracts to participate in the merge, a network upgrade aiming to make Ethereum proof of stake blockchain, also called the Beacon chain. Well, no, not necessarily. It will be both chains. That's just one part of it, but that's okay. As a result, they receive ST ETH representing their staked ETH balance with Lido. I do have to mention, like, from a technical perspective, I think like Cointelegraph and CoinDesk could do a much better job. Hopefully just by me reading this and like explaining it a little bit more, that you guys are getting a better understanding of the actual like technical details behind it, because there's clearly like stuff that they say, like the proof of stake blockchain, also known as the Beacon chain, which is not really accurate, right? You're going to have to run both the execution layer and the consensus layer to stake. All right. Users will be able to redeem staked ETH for unstaked ETH when Beacon chain goes live. In addition, they can use staked ETH as collateral to borrow or provide liquidity using various decentralized finance platforms to earn yield. Remember, we talked about this Lido thing before, I think a couple months ago, or just last month. And the thing is like they put in this kind of stipulation that if you buy it right now, you can't sell it until the merge. But that was before they really understood, or we really understood, that you couldn't unstake the ETH anyways post-merge. And that's why I was trying to articulate at the beginning, like, I think they're missing this entire point. So anyways, but if the if the switch to ETH2, and this is the other problem, is we keep getting this ETH2 nomenclature for the merge. Once again, that's why I asked Charles Hoskinson when he says ETH2, what is ETH2? What does ETH2 mean to Charles Hoskinson compared to like what it means to, of course, like Cointelegraph, which clearly to Cointelegraph, ETH2 means just moving to proof of stake. This could cause massive liquidity problems across DeFi platforms, Mill asserts. Using Celsius Network, a crypto lending platform that offers up to 17% annual percentage yields as an example. Quote, if customers start withdrawing from Celsius, they will have to sell their staked ETH, Mills explained. Celsius has liabilities of 1 million ETH, so 288K or 1,000 are inaccessible until the merge. 30,000 are lost and 445,000 are staked ETH and 268,000 are liquid, could cause a run. Regardless of unverified rumors that Celsius could be insolvent, the best way to secure your funds is to control your own private keys, he adds. Well, of course. Staked ETH might not depeg, but the risk of DeFi contagion in crypto bear market is high. Moreover, even centralized yield platforms could face insolvency risks due to their ETH liabilities, argues market commentator Dirty Bubble Media, citing crypto asset management service Swissborg as an example. Swissborg offers daily yields on about $145 million worth of Ether it holds, including 80% exposure in staked ETH or ST ETH. And it's whenever you see ST ETH, basically think wrapped version of something, basically a token that represents a staked portion of Ethereum. The firm has staked around 11,300 ETH out of its total Ethereum holdings in Curve's ST ETH pool. Then the ETH peg became imbalanced on May 12th in the wake of Terra's collapse, with ST ETH dropping to 0.955 on the day, basically starting to decouple. How is Swissborg paying daily yields on these assets when the yield from staked Ether is locked along with the principal, questioned DBM? And that's a great point, because once again, we're going to go back to this. You have the same problem post-merge because there is no withdrawal ability for these companies. So they can't liquidate it. So they have to push out and say, hey, at this point, like you still can't actually liquidate your ST ETH, right? Adding that it could have the firm exit their entire ST ETH position, thus forcing its ETH peg even lower. Meanwhile, the warnings coincided with a whale dumping its staked Ether position for ETH on Wednesday. And they have basically here, they swapped 19,747 staked ETH to ETH itself. Why would they do this? More than likely because they are aware, a big holder like that, a big whale, I'm hoping they're taking a look and being like, hey, wait, what's going on here? Mills responded saying that the ST ETH dynamic is no different than GBTC at a perma discount. In other words, sell pressure can be merciless once the market flips bearish and yields vanish. He explained when there's deep liquidity and potential to arbitrage, quants, Wall Street raccoons, and flash boys, I like that, will milk the yield. When the strategy goes against them, they will add merciless sell pressure. As of Thursday, the ST ETH and ETH ratio had recovered to 0.97, still 3% below its intended peg. So it's already depegged a little bit. The idea here, once again, is that if Ethereum doesn't move to proof of stake on time, that people will not be able to unstake the staked Ethereum, and the people that have the wrapped staked Ethereum will liquidate that, basically depegging them, because you won't be able to add the liquidity of actual ETH into the market to compensate for that. This problem persists. So I agree with the article that on the premise, essentially, you have a problem of this staked ETH token wrapped that represents a portion of staked ETH that you can't liquidate. And if the merge didn't happen, or if the merge happened and withdrawals were enabled, then you don't have a problem. But I say either way, whether Ethereum is able to actually complete the move to proof of stake or not, it remains a problem, because we don't have that ability to withdraw the staked Ethereum that is represented by the staked Ethereum token. So if you have ST ETH anywhere, and this isn't financial advice and blah, 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 I would get it out. Like I would copy whatever this whale just did. That's what I would do. I don't like, just period. That's how I feel about it. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.